Right now, there is a financial tug-of-war happening across two of the world's biggest commodity markets, and almost nobody in mainstream media is talking about it. On one side, you have New York's COMEX, the exchange that sets the global price of silver. Their deliverable silver vaults have fallen to critically low levels. And on the other side, you have Shanghai, where silver is trading at prices 40% higher than New York. 40% higher. What does that tell you? It tells you that the East and the West are fighting over the same metal, and somebody is going to run out first. In this video, I'm going to break down exactly what's happening in the silver market right now, what the numbers actually mean, and most importantly, what smart money is positioning for before this thing fully ignites. Stay with me through the end, because I'm going to show you the specific setup that analysts are calling a potential breaking point for March 2026. Before we dive into the data, I need to break something down for you that is genuinely alarming, genuinely exciting, and genuinely a once-in-a-generation kind of moment. Hit subscribe right now if you want to stay on the right side of this trade, because the window is closing fast. All right, let's look at the charts. Where is silver right now? Let's start with the basics, because the context here is absolutely wild. As of early March 2026, spot silver is trading at around $94 per ounce. Now, to some of you, that might sound high, but here's what that number actually means. 1 year ago, silver was trading at roughly $32 per ounce. That is nearly a 200% year-over-year increase. Silver has almost tripled in 12 months. And yet, and this is the part that blows my mind, most people I talk to still aren't paying attention to it. Now, some of you watching are probably thinking, okay, it already tripled, isn't it too late? That's exactly the question I'm going to answer today, because the data suggests we might still be in the early innings of something much bigger. But to understand why, you need to understand what's actually driving this move. And it's not just inflation, it's not just gold going up. There's a very specific, very physical reason this is happening, and it comes down to one word. The COMEX situation, a ticking clock. Let's talk about COMEX first, because this is where the global price of silver is set. COMEX is a futures exchange. That means traders buy and sell contracts representing silver, most of which never actually result in physical delivery. Traditionally, it's a paper market. But here's where things get interesting. COMEX has warehouses, physical vaults where actual silver bars are stored. And those vaults are divided into two categories. Eligible silver, metal that's stored there but not necessarily available for delivery. And registered silver, metal that's been officially designated as deliverable against futures contracts. Registered silver is the number that matters. That's the real backstop. That's what shorts have to deliver if someone actually demands physical metal. So what's the registered number right now? Approximately 86 to 88 million ounces. Now that sounds like a lot, until you compare it to this. The total open interest on COMEX silver, meaning the total number of outstanding contracts, all the paper promises, implies roughly 230 to 430 million ounces of silver obligations. You're looking at a coverage ratio of around 20 to 24%. In simple terms, for every 5 ounces of silver that's been promised on paper, there's only 1 ounce physically sitting in a deliverable vault. And it gets more specific than that. On what's called First Notice Day, February 27th, over 10,500 contracts stood for actual physical delivery. That's 52 million ounces demanding real metal against an 86 million ounce registered pool. And here's the kicker. Those vaults have already been draining fast. In just the past 60 days alone, 74 million ounces of silver left COMEX warehouses. Total inventory is down 32% since October 2025. When analysts talk about a squeeze, this is what they mean. When the paper promises start colliding with physical reality, that's when things can move very, very quickly. Now, I want to be clear here. This doesn't automatically mean COMEX defaults or the system collapses. Exchanges have emergency tools. They can adjust rules, require cash settlement, raise margins. But even without a default, this kind of supply stress has historically caused explosive price moves. Meanwhile, in Shanghai, now here's where the global puzzle really starts to come together. While all of this is happening in New York, on the other side of the world, in Shanghai, the silver market is sending a completely different signal. On China's Shanghai Futures Exchange, the SHFE, silver futures for March 2026 settled at the equivalent of roughly $108 to $110 per ounce in US dollar terms. COMEX, $94 per ounce. Shanghai, $108 to $110 per ounce. That's a premium of $15 to $40 per ounce, depending on which contracts you compare. In a normal, healthy market, that gap shouldn't exist for long. Traders would immediately ship silver from the cheaper market to the expensive one and pocket the difference. That's called arbitrage, and it usually closes price gaps within hours or days. But that gap has been persistent, and that tells you something important. The arbitrage is broken, because getting silver into China right now is extremely difficult. There are export restrictions, a 13% VAT on physical removal from Chinese vaults, logistics hurdles, regulatory quotas, all of it creating friction that prevents the normal flow of metal. And Shanghai's own inventories? They're at historic lows. SHFE silver stocks have fallen to just 346 tons, roughly 11 million ounces, down 89% from their 2021 peak, down 75% year over year. Think about that. Chinese silver inventories are nearly gone compared to where they were just a few years ago. Why? Industrial demand. China is the world's largest manufacturer of solar panels and electric vehicles, both of which require significant amounts of silver. That domestic industrial machine has been relentlessly pulling silver off exchange shelves. So you have this fascinating and somewhat alarming situation where West vaults draining due to delivery demands and Eastern arbitrage flows. East vaults draining due to industrial consumption, both in backwardation, meaning the market is paying a premium for metal right now over metal in the future. Backwardation in a commodity market is the market screaming, "We need this metal today. We can't wait." There's a phrase circulating in the commodities world right now, the warehouse war. The idea is simple but profound. Eastern industrial demand and Western paper markets are essentially competing for the same finite pool of physical silver. And that competition is accelerating the drain on both sides. The warehouse war. Here's how the flow works. Chinese manufacturers need silver for solar panels and EVs. They pull it from SHFE vaults. SHFE stocks crater. Now Shanghai prices spike to attract imports from the West. Traders see a $30 plus arbitrage opportunity. Buy cheap in New York, ship to Shanghai, sell at a huge premium. So they pull silver from COMEX vaults. COMEX stocks crater. Western delivery risk increases. Prices rise in New York too. Meanwhile, China's government has restricted silver exports since January 2026, meaning once metal gets into China, it largely stays there. It's a one-way valve. Silver flows east, and it doesn't come back. This is not a conspiracy theory. This is basic supply and demand playing out across two of the world's largest exchanges in real time. The numbers confirm it. The price premiums confirm it. The backwardation confirms it. What do the analysts say? Okay, so given everything we just covered, what are major institutions and analysts actually forecasting for silver in 2026 and beyond? And look, I always want to be transparent. Price forecasts are educated guesses. Nobody knows where silver ends up, but it's worth knowing what the big players are thinking. JP Morgan has an average 2026 silver forecast of around $81 per ounce for the full year. But that was set before this current surge. They acknowledge upside, but warn of volatility. Bank of America is considerably more bullish. Their base case puts silver at $135 by year end. with an extreme scenario above 300 if the gold to silver ratio compresses back to historical norms. Deutsche Bank targets $100 per ounce as an end-year figure. Trading economics models suggest roughly 97 to 116 over the next 12 months. On the more aggressive end, some quantitative models are forecasting figures in the $200 to $388 range, though those come with a lot of assumptions baked in. The consensus? We're probably somewhere in the $80 to $135 range for 2026, with significant upside risk if the physical squeeze accelerates. For context, at 94 today, even the conservative forecasts suggest the price is already trading ahead of base case targets. The market is pricing in the squeeze risk now. The big picture. Why silver? Why now? Beyond the warehouse drama, let's zoom out for a second, because the structural story for silver is genuinely compelling regardless of short-term squeezes. We are now in the 6th consecutive year of a global silver supply deficit, meaning the world is consuming more silver than it's mining every single year. For 2026, that deficit is estimated at roughly 67 million ounces. Industrial demand, driven primarily by solar energy, electric vehicles, 5G infrastructure, and consumer electronics, now consumes approximately 59% of all silver supply. Silver isn't just a precious metal anymore. It's a critical industrial input for the energy transition. And unlike gold, you can't easily recycle most of the silver that goes into solar panels and circuit boards. It gets consumed, it disappears from the market, permanently. When you combine that structural consumption story with the acute warehouse pressure we discussed, you start to understand why so many serious analysts and institutional desks are paying close attention to silver right now. So let me bring this all together for you. We have COMEX vaults draining at record pace. We have Shanghai trading at a massive premium with its own inventories near all-time lows. We have a 6th straight year of global supply deficits. We have industrial demand that isn't going anywhere. And we have March 2026 as a key delivery month where the rubber meets the road between paper silver and real physical silver. I'm not here to tell you what to do with your money. I'm not a financial advisor, and nothing in this video is financial advice. Every investment carries risk, and silver, especially through leveraged futures, can move violently in both directions. What I am saying is, the data is worth watching. This is one of the most interesting setups in commodities markets right now. If you found this breakdown useful, hit that like button. It genuinely helps this channel get this kind of analysis in front of more people. Subscribe if you want to stay ahead of moves like this. We go deep on commodities, macro, and market structure in a way that most finance channels won't. And drop a comment below. Do you own physical silver? Are you watching the COMEX setup? Let me know your take. I'll see you in the next one.